guidance. Joining me now, Main Street Asset Management Chief Investment Officer Aaron Gibbs. And Aaron, there has been hell to pay for companies that have missed, offered lower guidance, or just didn't say the right thing. I mean, it's like...
yeah, if like our revenue switched from this area to that area, oh, that's a negative.
It's like, I mean, it's nuts. It really is frustrating. If you own a stock, if you're an investor and it's down 20% in one day, 30% in one day, it's like, could the news have been that bad, especially when the headline comes out, they beat on revenue and earnings?
Yeah, and this is exactly what happened to Apple in that, you know, they're doing well. They beat top and bottom line. The problem is that people focus on the fact that they had slowing growth, but we already knew that going into earnings season.
Right.
We knew they had 4 quarters of slowing growth. So it's as if, you know, our actual expectations are you're going to beat so much that you're actually going to go into accelerating growth.
Does that get to the old term, price for perfection?
Absolutely. And we've been seeing this with the mega caps. And look, we know that any type of growth stock right now has a lot of headwinds. And when we're looking at these higher interest rates, it's growth that hits the hardest. Those higher valuations can really be compressed. And if you do not not even beat just the official numbers, but every other unidentified expectation in there, you're going to get beaten up, and that's what we've seen this earnings season.
But also that's where you create the opportunities too, right? I mean, honestly, if you're going to seriously outperform the market, you buy these names when they're oversold. They're just when the emotions are driving them down more than fundamentals.
Absolutely, and when you see some of these, gap down days where we've seen, where it drops 8% on one day and then, recovers in the next 3, those are the days where you can make quick, easy bets. But for me, look, if you're not willing to trade that quickly, I'm still more defensive now. I'm still looking at more value-focused companies. I'm not buying anything that's too expensive because I'm not willing to trade them as quickly.
So one name that you like in the consumer staple side is Monster.
Yes. So Monster beverages are one area that we do see nice stable growth. Its stock price really got hammered in October and September. Right now, I think there's a really good run up where it can go back up to 55, still easy valuation, so a nice easy trade. I think you could run that through the end of the year.
I was a little surprised to see like retailers a couple of discount retailers.
Yeah, well, we've been so out of favor with retailers because we've been spending all our money on travel. And look, I still love Expedia and Booking.com and all that great stuff, but discount retailers are really looking positive over the next few quarters. Again, nice safe valuations, not too expensive. These guys have been running really well the past few weeks since mid-October, and I think that again can easily continue through the end of the year.
So right before I came down, I looked at the last 5 days, and it's still the growth sectors, right? I mean, real estate is having a real good 5-day stretch. I'm not sure what's powering that.
Yep.
But you're still cautious on these mega cap type names.
Absolutely, and anything that is sort of high risk. So whether it's mega cap growth, whether it's small cap, I'm still staying off the table because we do have such big headwinds. We don't know if those 10-year yields are going to pop up again. That was sort of a disaster sort of the last 2 weeks of October. I think until
could it have been climactic? I mean, one of these things where you tickle that 5% number on the 10-year. Everyone was worried that it would happen. Then, in the moment, you never know, right? You default to, oh, man, if we go north of 5, what's next? But what if that was the top?
Then I think we could finally maybe see 2024 being a safe sailing year, a little less exciting, a little less volatile than what we've seen in 2023. I think that would be great if that really was like the top level, but it remains to be seen, and I'm not ready to make any major bets one way or another. Right now, I'm still more on the defensive area.
So before I let you go, there was some speculation that when Jay Powell spoke, the market, that rally the market had, we hadn't seen that in the last 10 prior minutes. The market always went straight down.
Since he started,
that
right?
Jay Powell knew that today's number would be a little weak, but also on Monday, when the New York Fed comes out with their senior loan officer survey, that's going to be show extreme credit tightening, and that's could be a 1-2 punch that could really get us into a year-end rally. You buying it?
Yeah, I am. I do think that finally we could see some economic news that would be at least good for stocks and good for rates going forward.
All right. Thank you so much, Aaron.
You're welcome.
Always appreciate it.